Good afternoon, everyone. Welcome to this relatively beautiful day here in Tamaki Makaurau, Auckland, for the next instalment of the Money for Good seminar series by Mindful Money. My name is Claire Brabant and I'm a Senior Associate in the Financial Services team here at Minter Ellison Rudd Watts. And we at Minters are very proud of our ongoing association with Mindful Money and the impact it's having on making money a force for good. Sustainability and ESG matters are becoming part of the common vernacular in the financial services space, and the importance of investment stewardship within responsible investment is becoming increasingly more focused, so this seminar is particularly topical. Before I hand over to Barry, who will introduce you to our panel of speakers, I'll just run you through some quick housekeeping. Bathrooms can be accessed out past reception on the left-hand side through the sliding doors. In the event of an evacuation, please follow your Minter Ellison representative who will guide you through the stairwells and take you to our meeting place. And if you've not already done so, please turn off your cell phones or put them to silence so that you can enjoy the excellent dialogue and thought-provoking discussion from our panellists. So without further ado, I'll introduce Barry Coates, the founder of Mindful Money. Kia ora, Barry.
Kia ora. Kia ora, ngā mihi nui ki koutou, in Rorangatira mā, nau mai, haere mai, whakatau mai, ki tēnei hui. Ko Barry Coates aho, ko te kaiarahi o te patea whaiwhakaro, nā reira tēnā koutou, tēnā tātou katoa. Tihei Māori ora. So welcome all. Thank you very much for coming along to this, and thanks to our audience online, on video and on podcast. So for our panelists, the gaze will be split to audience and to our audience online. So this is, as Claire said, and firstly I should say a very, very huge thank you to Minter Ellison Rudd Watts for having us as their guest in this beautiful location, but you can't see it online. So we're really pleased to be here, and thanks for the welcome. This is the 17th in our series, current series, third series. So we've covered lots of topics, and they're all available online on Mindful Money and in various good websites and through the podcast series. Seminars are generally held around 12:15 on Wednesdays, and so we hope to see you at future ones as well as today. The topic for today is unpacking the issues of stewardship. As Claire said, stewardship has become a strategy of choice for many in the investment sector, and it is, I guess, a really important strategy, but not well known amongst wider audiences. So one of the reasons that we wanted to do this was not only to talk to those in the investment sector and the finance sector, but to try and get this message out to a broader audience, particularly through our videos. And so we're going to have a panel, who I will introduce in a second, and then open up for questions, and there'll be plenty of time for general discussion. And as usual with these seminars, we keep it pretty informal, so we look forward to challenge as well as commentary. So let us know what your questions are and comments, and maybe even critiques. Before we start, I should let you know we're talking about some specific funds in this seminar. They're going to be used as examples of different stewardship approaches. The seminar is about information on stewardship. It's not intended as financial advice for any individual, nor a recommendation to invest in any specific fund. So, with that caveat, let me introduce our great panel on stewardship. So please come up and join. As they're coming up, I first want to welcome Jessica Cairns, who's visiting from Australia. Jessica is Head of ESG and Sustainability at Alphinity Investment Management. Next to her is Jackson Rowland, who's lead for the New Zealand Stewardship Code Secretariat, recently formed. So many people have a great deal of interest in the Stewardship Code. So it's great that Jackson is here, and it's been a pleasure to work on this seminar with the Stewardship Code, and we're very pleased with the collaboration. Thank you. And Francis Sweetman. Francis is Head of Sustainable Investment at Milford Asset Management and has been a frequent presenter on our seminar series. So welcome back, Francis.
Thanks, Barry.
So let's kick off. I've asked the panelists just to say a bit more about themselves and their job title, and to talk a bit about the organisation they work for, and maybe to put stewardship into the context of their investment strategy. So Jessica, please, over to you.
Yeah, so as Barry said, I'm Head of ESG. So Alphinity is a boutique investment manager. We're based in Sydney. Currently have about 20 billion in funds under management across Australian and domestic equities. And in the context of stewardship, I think for us, so we do have, I should say, core funds, what we consider core funds, and sustainable funds that invest around the sustainable development goals and have a bunch of additional exclusions. But when it comes to stewardship and our policy for stewardship, that's consistent across the whole firm. So it doesn't really have to do with whether the company is being held in our sustainable funds or our core funds. Our approach is wider. And we consider stewardship to be corporate engagement, proxy voting activities, research and partnerships, working with other investors, contributing to knowledge, policy advocacy, all of that stuff really for us fits under that stewardship bucket. And we generally focus on things like higher level thematic risks or system-wide issues like climate change or modern slavery or biodiversity.
Great, thank you. Why don't we come to Francis first, and then we'll do stewardship a bit after.
Sure, thanks, Barry. So at Milford, I suppose we've got a really strong foundation in stewardship from one of our founders, Brian Gaynor, who was all about being a voice for the small retail investor, and then also just being a voice for reason and fairness in the New Zealand financial markets. And we didn't really formalise our stewardship approach until a couple of years ago, when we sat back and really thought about what we wanted to do on sustainability and how we could best do it with what we do. So we're an active manager. We build all our portfolios bottom up across New Zealand, Australia, global equity and fixed income. And so we're a big team, there's 40 of us. And being active and also now being quite large in an Australasian context, we thought gave us a voice. And that was the best way for us to try and progress all sustainability initiatives, including climate change. So we are all in on engagement. It's sort of our main approach. We don't have particularly large exclusionary categories. We will use exclusion where we need it, but it's certainly not what we're about. We're absolutely about stewardship, and that's proxy voting and whole different types of engagement that I think we will probably dig into a little bit more as the seminar gets going.
Yeah, great. And Jackson, welcome.
Thanks, Barry, and thanks to Minters for hosting us. Kia ora koutou. My name is Jackson. So I lead the Stewardship Code Secretariat in New Zealand, which is effectively the body that manages the code and kind of brings that to life, including encouraging signatories to sign up, as well as supporting signatories and non-signatories to really deepen the stewardship activity and the outcomes that they're having in New Zealand. The code is relatively recent, so it's about a year old now, and so I'm recently in this role after being overseas doing some study in the sustainable finance space recently and really seeing a growth of stewardship as one of the key RI strategies globally. So it's really great to come back here to New Zealand and see really the building movement around stewardship here.
Cool. So for the purposes of this seminar, when we're talking about stewardship, we're talking about investment stewardship, and we're particularly talking about the corporate governance processes that are undertaken generally by investment funds acting on behalf of pooled funds like KiwiSaver or retail investment funds. So effectively acting on behalf of individual investors. So that's generally the aspect of stewardship that we'll be focusing on. But we want to start off with saying, so what are the different forms of stewardship? So let's kick off with maybe with the formal processes of voting. And so Jess, maybe you could start off with the voting aspects and others then chip in.
Yeah. So as I said, like for us stewardship, there's different tools, I guess, that you can use to enable stewardship. And like Francis said, access to companies is simpler for larger sort of managers. So, getting access to boards and CEOs and things like that to talk about important issues is relatively straightforward for us in the Australian market. So being a fairly large investor, for the global market, we find it a bit more challenging because we are a small fish in a very big pond globally. So, thinking about how you can kind of create leverage and stewardship impact through other mechanisms, not just engagement's important, and proxy voting for us is one of those. So proxy voting, like Barry said, we mostly for our institutional clients, so super funds and things like that, they do their own voting, but we provide advice. But for our retail invested funds, we vote on the behalf of the individual investors, and we also vote obviously for anyone else that would like us to from the institutional side as well. What we've sort of used in terms of our structure for voting is like an escalation type strategy. And I guess you'll probably talk about this as well in terms of the code, but we don't go straight to voting against a director. If we have a particular issue with a company, we do try to engage first. If we can't engage, we try to speak to, investor relations, which is obviously, a much easier avenue to take. If we can't get it that way, we might work with other investors to try to sort of, pull together resources and focus areas and see how we go there. And then over a period of time, we may eventually vote against things like remuneration reports within the Australian market is often a good mechanism for demonstrating dissatisfaction with a governance issue or something that might be going on for the company. And then we may vote against directors as well. And an example was probably our Woodside vote in 2022. So we hold Woodside in our core funds, not our sustainable, because we exclude fossil fuels. And we've been engaging with that company for, I would say, 2 or 3 years, specifically around their climate strategy. We voted against their Say on Climate position, which was a sort of request to shareholders to vote on whether we felt that their climate strategy was good quality, which we indicated, no, we do not. And we did that in 2021. We engaged with the board a number of times during that year. And then in 2022, we decided to vote against one particular director who has a very strong history in lobbying government around fossil fuels. He's been on the board for a very, very long time. And we felt that strategically, the business was not focusing on the right opportunities in terms of the transition. They were lagging behind global peers, and a shake-up in that board structure was necessary and needed. So that was an example of where we sort of executed that escalation approach of kind of stepping through a progress, and then eventually, and then we also issue a letter to the board to explain why we voted against the director and requested further engagements for this year to kind of see progress. The other element I think that's quite interesting in the proxy voting space globally is shareholder proposals. So in the Australian market, and I've seen in the New Zealand market as well, shareholder proposals are not really a thing. So generally, we vote on what the boards would propose to shareholders. In the global market, shareholders with more than 3% sort of collective ownership of a company can put up a proposal for vote. They're generally non-binding, but they are used, and we use them as well as a way for kind of creating that advocacy where you can't get the access, and they're often on like ESG topics. So 2022, there was like 529 shareholder proposals across MSCI World. Companies like Amazon, Google, Facebook, or the big, they can have like up to 20 individual shareholder proposals on, issues around gender, around like, living wage. It can be on governance aspects, around climate lobbying. It can be on all sorts of different things. And that's a really interesting difference, I think, between the two markets. And, there is some push in the Australian market, that maybe something like that could be a good way to just create that additional voice to some of these boards that might not give access to all investors.
Just as a side note, New Zealand doesn't have the same minimum shareholding requirements for filing resolutions from shareholders. But to my knowledge, there hasn't been any social or environmental resolution ever put up in the New Zealand market context. Lots of resolutions on governance issues, but not on social and environmental issues. So it's certainly something that Mindful Money is interested in having a role in promoting in the future.
Yeah, it's fascinating because it's almost like there's a first mover issue there where no one wants to put their foot out first. And it's something that we think about because we obviously vote globally and we have an escalation strategy that we're only a couple of years into our proper engagement approach, as I said before, so we haven't really had to use any of our escalation frameworks yet. We're getting really, really good take-up, we're getting really good feedback, we're using quite a collaborative type, constructive approach, so it hasn't been an issue, but it's something that as a business we're absolutely prepared to do. Just sort of watching and wondering if anyone else is too, and who's going to move first and what that's going to look like. But I'm sure there are plenty of others that are thinking about it. And I wonder if actually the Stewardship Code may have a role to help start to encourage some of those behaviours.
Absolutely, and I think that applies with stewardship generally, is that when we're all operating in our offices, we don't realise what everyone else is doing, and we don't realise the extent of stewardship activity that's already happening in New Zealand. So a big benefit of the Stewardship Code is that monthly the signatories come together for a call just to share candidly kind of what they've been learning, what they've been observing in the market. And one of the big outcomes of that is multiple signatories have commented, I didn't realise so much was going on. And so when someone on those calls maybe starts to share, hey, we're thinking about filing a shareholder resolution, probably others will say, hey, that's interesting, etc. And it could start, that momentum starts to build from there. So that's one of the benefits of having this secretariat in the Stewardship Code is really bringing investors together to show what practice is actually happening out in the market rather than us all operating in our silos.
Yeah. Sorry, I was just going to add, because voting, where you can really get voting is obviously all about collective momentum and collective power, and as investment managers voting on behalf of your investors, either trying to represent their values or absolutely representing the values that you have communicated to them you will represent as an investment firm is incredibly important, and it's just what you should do as a good manager. But to really get change, obviously you have only got your small proportion of votes, and so you need everybody to really do that, and also to have those kind of similar shared values on certain issues, which is where you really need a little bit of kind of collective action, or at least the ability to sort of discuss some of those things, and a forum like the NZ Stewardship Code is a great one for that.
And
I was just going to say, generally though, I think it's, proxy votes, if you look at the sort of voting records across most companies, like 98% would be vote for, generally. So, each year, generally for remuneration reports or board elections or whatever it might be. So, at 1 to 2%, maybe 3% is fairly normal against, so it doesn't actually take a lot for boards to really sit up and take notice. Like even a 15% vote against is reasonably material, and getting up near a 30%, which is what we've seen with some of these oil and gas companies with their say on climate votes and different things. Woodside was 48% against, I think, and Santos was 38 or 36%. But that's like a really kind of big deal to the companies as well. So I think that's important. But it's also important to sort of communicate why the votes are against, not just the action.
And also you can get ETF or just index funds involved. So this is something where everybody who's invested can actually use stewardship and engagement to try and get outcomes, whereas an index fund obviously isn't going to be able to go and talk to every management team, but they can absolutely join a sort of collective voting strategy.
And as Jackson said, there are needs for coordination mechanisms to basically bring the power of investors together and avoid duplication. And this also came out of the survey that we did last year with Centre for Sustainable Finance and the Investor Group on climate change. that there was strong feedback to say that collaboration around interaction with companies, engagement and voting would be really helpful. So it's great that the NZ Stewardship Code would be doing this work. Can you describe just what kind of mechanisms there are in Australia to coordinate across shareholder action and more generally stewardship?
Yeah, so there's lots of like formal, I think, and informal structures that are sort of popping up in Australia, and there's a lot more managers and asset owners as well, where that sort of stewardship focus is becoming, you know, much more critical, and that sort of system level risk, like I described, is becoming much more critical. So we have, there's quite a few. There's Climate Action 100 Plus, which is a sort of collective action around climate change, and they have like a collaborative engagement program where they assign lead investors and then support investors on particular companies. So we are support investors for Orica and Incitec Pivot. And I should say we aren't actually shareholders of those companies as well. Like we were in the past and we're not now, but we're sort of still staying involved. And we're on a couple of global businesses as well. There's also a really good one that the PRI just launched in December around modern slavery. So it's called their Advance Engagement. And again, there's Australian companies and global companies that I understand that they're also looking at kind of expanding that a little bit more this year as well. But that's a similar model. We have lead and collaborating investors. We're also part of one around antimicrobial resistance, but that's more in the global equity space. And there is a lot more, like I say, that informal sort of working together. And I think this is an overarching kind of lesson in this stewardship space that, like I said at the start, Alphinity has 20 billion in FUM. So we're a decent sized manager, but compared to Fidelity, who is somebody that we're working with at the moment, they have $1 trillion. So, you know, like we're decent size, but if you really want to get attention sometimes on issues, working with some of the massive managers as well as asset owners really does help. So we did some work last year around workplace culture and sexual harassment in the mining industry with all the issues that went on at the start of last year. And the head of sustainable investing over at Fidelity and I know each other. So we've sort of connected up now. We've connected with Hester and BFMC, which is another institutional owner in Victoria, to sort of work together a little bit more to really proactively engage with Rio Tinto and BHP specifically on this issue. Just recognising that, you know, individually we can all run around and do our own thing, which is fine. But fundamentally, like we really do want change, and we really do want these companies to actually stand up and do things differently for women on their work sites, in their mining camps, and we want to see them doing things differently for their overall kind of workforce, and we think that creates business value. So yeah, that's stuff like that I think is starting to happen a lot more just through the general kind of ESG community in the space as well. Like a lot of this stuff isn't necessarily competitive advantage, you know, it's just really, it helps that you know, issue is solved, that helps us, it helps them, it helps a wider kind of industry, and that's kind of the most important things sometimes.
And Jackson, you've had a look at some of the global mechanisms around this in the context of New Zealand Stewardship Code.
Yeah. And this kind of collaborative engagement that we're talking about is one of the stronger themes, I think, within stewardship, and where a lot of hope comes towards stewardship, that it will be a powerful force to tackle some of these systemic challenges that the world is seeing, whether it's climate related or others. So there's a number of wide collaborative engagements globally that are making a meaningful difference in this space, and it's certainly a key part of the New Zealand Code that we hope to see investors collaborating more back home with some kind of coordination and facilitation around that. I'd add that there's been some challenges around stewardship in the media at times around the limited outcomes that investor engagement can achieve. For example, with fossil fuel companies recently, and unsurprisingly, not all fossil fuel companies have completely divested or completely exited from fossil fuels despite investor engagement. And I think we've got to take all of this with a grain of salt, in that despite all of our best intentions, there's only some outcomes that will be able to be achieved through engagement directly with the companies. But what investors are also starting to do globally is engage with policy. And so some of the collaborative engagements we've talked about already have a specific policy bent, and rather than specifically and only talking to the issuer, they're also talking to the relevant legislators and governments in the country to try and come from that angle as well. So it's just another example of where investor collaboration can achieve some pretty significant outcomes when you bring those groups together that we're talking about.
It's also a related aspect is investors calling on some of these companies to get out of industry associations and advocacy, for example, against action on fossil fuels. So in the US, that's been very strong in terms of shareholder action to prevent that climate denial funding and advocacy. So I guess that's another style of policy engagement.
Absolutely.
So Francis, what do you see as kind of some of the ways that a collaborative mechanism could work in New Zealand? And you know, when we're getting to the stage of saying, so how does this collaboration look? How does it work? What data is shared? Are people going to share their data, for example, or is it going to be proprietary because many funds do their own surveys of companies and generate data and don't necessarily want to share that with others? How's all of that collaboration going to work?
Yeah, it's a great question, because there is some of that sort of friction, let's say, across collaborative engagements. I think, well, first of all, we've got some fantastic models from offshore for how to do this. So we can just lean on that really heavily. You always need a lead engager to do a lot of the heavy lifting, and that is just at the goodwill of the company. But you know what, to be honest, everyone is so aligned in trying to get outcomes, and we're all, particularly the sustainability people, are doing this because we're really passionate about it. So I don't really think that would be an issue in New Zealand the same way it hasn't been anywhere else. Everyone is willing to chip in and contribute. The data issue, it's really interesting, because if you would have asked me 2 years ago, I would have said one of the reasons why we feel like we're capable of going out and engaging is because we have a 3-person dedicated sustainability team that does all our own bottom-up research on effectively best practice. So we can sit down at a table with someone like a Santos, and we can credibly have a conversation about them with their carbon capture and storage, and whether their decarbonisation efforts are legitimate or they are not legitimate versus what we know about that industry and the technical aspects of some of that. And that's really important. But actually, now I sit back, I think you can go in and say, hey, Santos, your targets don't align with a Paris Agreement sub 2 degree scenario. What are you going to do about that? And I don't actually think you need to be really massively educated and have a huge amount of data, or even really be science backed, in order to be legitimate in your engagement in that. And I think you still have a right to go and expect a company to decarbonise in line with well-established transition pathways, without having to have all of that data and backing behind you. I mean, when it comes to something like a collaborative engagement, everyone at the table should be prepared to contribute, and that's why having someone like a Climate Action 100 Plus or IGCC coordinating that, and having that experience, so where on Santos and Qantas, has helped us learn so much about engagement. And using some of that discipline is absolutely key. So having kind of a collaborative group to organise all of that is really important, but I don't think you necessarily need to be really specific about that.
Although I would say that companies are often very good at how should I say, deflecting those views and waffling and pretending that they're doing more than they are in ways that sound very credible. But unless you have that data, it's quite hard to kind of call them on it and get down to the deeper conversations, right? So I can understand why you guys would invest in that.
True. Maybe I'm being flippant because we know that we've got it. But I think some of that also comes down to a really committed escalation framework. and also the weight and support of having other people behind you and with you. So, I mean, absolutely. But, I think you can be credible and legitimate and forceful without it if you're prepared to be so.
Yep.
We also, maybe I just said, we also, for our collaborative engagements of Climate Action 100+, which I quite like, so I'm actually not involved in those, that's our analyst. So our analyst that actually covers Orica and IPL, who's very passionate about climate as well, is actually the lead investor. And I found like it's very, very valuable, like having somebody with that deep knowledge of the company. So often these engagements are led by ESG professionals that obviously have, deep knowledge of the E issue or the S issue, but might not have the depth of knowledge on the specifics of the company that the analyst would have, because we, cover so much more. So Andre, he's actually able to sit down with the, as part of those engagements and working with ESG people from the other businesses, and sort of, being very specific about their targets and, be like, well, you've committed to a 2030 commitment here. I know because I know your assets, it should be 2026. Why aren't you pulling your target forward? And it's sometimes like that level of detail, like I wouldn't know that without going out and doing heaps of the work. So we found that really valuable as well as kind of pulling in, particularly for the climate discussions, because it does get very technical very fast. So we found that helpful as well.
Can we talk a little bit more about the types of engagement? So often people don't kind of always know what you mean by engagement. Do you mean kind of a telephone call once every 6 months, or sending an email to a public relations official within, or investor relations official? Does it mean talking to the board or senior management? What are the kind of tactics that you use for different situations, and how does that work?
Can I just start with a general comment, and then you can share your experience? I think because I think it's probably easy listening to this to think we're kind of suggesting that all investors should become kind of radical activist investors and could just continue badgering our issuers to change, when I think it's really important that there's a distinction between kind of activist and active investors, and very much what stewardship is about is supporting your portfolio to maximise the long-term value by navigating critical ESG risks. And as investors, we have a really good perspective on what those risks might be and how to best navigate them to maximise that value. So that's an important starting point that everyone sees, including the issuer, is that we're in this room because we have the same goal outcome. We want to collectively maximise value by navigating these risks, rather than the issuer seeing this as a frustrating, annoying experience. So particularly as this is building in New Zealand, some of the work the Stewardship Code is doing is also with the director side of the table to help them understand that this engagement is normal and value adding, and you should be engaging with it constructively accordingly, rather than in thinking this is an activist radical thing. And then the tactics, etc., of how to do that are seen in that light.
It's a great point. A really great point. And we work out who we're going to engage with and what we're going to engage on based on what exposures in our portfolio have the most ability to cause harm, where there's the most improvement needed, and that really speaks to that risk section. So, companies that are absolutely lagging behind and have got really high exposure, you start to see that reflected in share prices and risk premiums put on certain companies. And then where we've got the most influence, and so we sort of cross-section all of that and come up with a target list, and they're the guys that we go to. So how we do it, and Jess, feel free to just chip in if you do it same or different, is, for a start, I suppose it's worth saying that we sit in the investment team, and I'm from an analyst and portfolio manager background, and we do it together, the portfolio manager, analyst, and led by the sustainability team. And that's really important because it means we know the companies, we've got all that knowledge and data behind us, which is very helpful, even though I don't necessarily think you always need it. And we can kind of to demonstrate that it's not just a sustainability person over here with these priorities, that it's a Milford-wide approach, and it's really important for a number of reasons to all of us. We always start with the sustainability people, the investor relations, or the relevant kind of operations person, the kind of management people actually in charge of the day-to-day. And we have a really detailed discussion around what their approach is, what they're actually doing, because generally disclosure doesn't seem to live up to what's going on under the hood. Because green hushing, I guess, people are really kind of cautious about disclosing some of this stuff. And then we will progress, go away, do our work, make our recommendations, talk to them again, and then we'll generally raise to CEO and chair at the same time, and then have a discussion with CEO and chair, and then go back down and talk to the management layer again, and then go from there. And that's sort of where we've got to with all our engagements at the moment. We haven't actually moved into an escalation framework yet.
Yeah, I mean, it's similar. Like it is a good point. Like all of this really comes from a starting point on analysing the risks and issues for each company. So generally an engagement item, and I should differentiate as well between engaging to learn more, to inform your risk analysis, versus what we're sort of talking about with stewardship, which is more like changing behaviour for the company or establishing some sort of outcome that you want to achieve. So for example, and how we engage, completely variable depending on the topic. So, sometimes it will be with IR, and I was saying to someone earlier, like these days IR teams are being resourced with ESG people. So we meet with like Shell, for instance, in the UK, like we meet with their IR team, but they've got 3 dedicated ESG professionals in their IR team. So you don't actually have to meet with their sustainability manager, because the IR function knows all the details and they know what's going on, and it's a better model really, because then we're not distracting people that are like trying to actually get on with their day and do their business. And it's similar, some of the Australian companies are kind of starting to shape up like that as well, that the IR teams are getting so sort of across this. So yeah, who we engage with varies. It might be board, might be CEO or CFO level, it might be another executive if it's a different issue, or it might be people in the business. But what I was going to say is, just maybe 2 examples of the slight difference between engaging to inform your risk analysis versus engaging for an outcome. So, for example, most of you should hopefully know this example, but BHP is facing some litigation in the UK over the Samarco dam collapse from 2015. So this was an issue that I think people thought was largely, they were on the tail end of this. They're addressing most of the cases in Brazil, and their liability in Brazil, but there's been a UK class action that's popped up because they were dual listed in both regions. So a lot of the same claimants from Brazil are also suing, and they've got these big US class action lawyers that are recruiting, I think it's up to like 700,000 claimants. The potential bill I've seen is like up to like $40 billion, and it just continues to grow in the papers. So that's an example where that cropped up last year. And the first thing we did was within 48 hours, like on the phone with investor relations and their VP for sort of their sustainability function, but sort of looks after engagement with investors on ESG as well, to understand what was going on. From their perspective, what do they think about this? What's happening? What do they expect the risk profile to be? And how have they included that in their provisions, in their financial reports? From that, the analyst increased his estimate for that provision and said, I think it's going to be more than what BHP have said, and I'm going to increase that in my model. We then met with the CEO as part of a fairly regular engagement, and this was a priority discussion in that meeting. So we spent 15 minutes getting his view on what was going on. We also met with a couple of UK lawyers and some independent people to get their view on what the potential worst outcome could be from this in terms of fine, basically. And then again, we have increased that provision in our model because we do think that they are probably going to be facing something pretty hairy in 24, 25. And that's an example where at the moment, it's not really like an engagement objective, because we don't know exactly what BHP have to do about that today. Like, they are doing quite a few things. So they're trying to close out the liability in Brazil, which they think will address, some of those claimants will kind of go away once it's closed out in Brazil. And they also are looking at sort of increasing, I think, some of the compensation in Brazil than they had before. So they're doing some stuff to try to manage it. And right now, this is like a watch and wait for us. We've increased our models and we've adjusted that. risk, but it's not necessarily an engagement objective. Another example, which is Brambles. So they make timber pallets, which is very easy for most people to understand. So one of their biggest risk factors is timber sourcing. Not surprising because they make timber pallets. They have commitments around sourcing like 100% sustainable timber. And they've got a very like big and loud ESG brand, Brambles. You know, this is one of their core value drivers. Like some of their big customers are things like Nestle and all of this that have lots of their own targets. And we found through, it's been a long story, but we found that Brambles weren't actually doing their own audits on that timber supply chain. They were relying on like a third party certifier. So if you've heard of FSC Timber, Forest Stewardship Council, which I'm not disparaging them at all, it's a very good organisation, but the rigour around some of the quality testing on those timber plantations was a little bit concerning, particularly where Brambles kind of hinges a really important part of their sustainability brand on that sourcing. So that was an area, we identified that as a specific risk to the company, and we have identified an objective for that. So what we want Brambles to actually do is do audits. And we want them to be able to tell us in the next meeting, which they couldn't do in the first meeting, how many plantations you actually source from and where are they? Because they know the mills, so they know like where it's processed, but they actually don't have the data and the visibility at this point to, which it was surprising to me, you know, and I thought this is an area, there's a lot of complexities in the reason why they don't have that. You know, they source from lots of different places, and I'm not underestimating how hard that would be for them to do it, but that's what we want them to achieve. And so we met with their head of sustainability. We've now raised this with their CEO as part of a recent engagement, and we'll be flagging this with their board as well at the upcoming AGM meetings that we have, just to let them know that we're also looking at this and we do think this is really critical. The company's confirmed that they are looking at introducing audits, certainly in high-risk regions. So we're seeing some progress, and this was a really good way to actually flag this issue to the sustainability manager as well, who actually wasn't really aware as well. So he's now gone back to their procurement team and sort of escalated. So, sorry, it was a bit of a long story, but there's two different examples.
Good story because it brings it to life, and these supply chain issues are going to be absolutely central.
And it's very complex. Like
modern slavery legislation, for example, is coming into New Zealand. That knowing your supply chain, disclosing your supply chain, is kind of really fundamental. Even if you've got a certifier, that actually that transparency around.
Just taking that like full ownership. I think that was the thing for me. I was like, you know, where this is it's so important. If they, like in that supply chain, if there was an issue that was found, that would have share price impacts for Brambles. You know, that is quite critical for them. So, and then, you know, we also do, like I said at the start, more of that sort of top down, you know, Brambles is like, that's a bottom up example where we sort of found something specific to the company. But we look at these sort of, higher level or top down issues as well, like modern slavery, where it's kind of relevant to everybody, really. It's not, but we've identified some high risk sectors where that's relevant, and then we have specific engagement programs on those for, you know, all companies in those sectors, really regardless of exactly what they're doing on it.
Cool. Francis, do you want to talk through sort of an example for Milford of how that engagement process works? I kind of recognise you may not want to divulge confidential discussions between Milford and particular companies, but...
Not at all, and actually it's funny you say that because I think transparency is really important for accountability and stewardship. I don't know if you've got a view on that, Jackson.
Yeah, just briefly, I'd add that I think whilst stewardship is so new in New Zealand, people are quite timid to say, well, actually, we've met with this company and we had quite a robust conversation with them. Whereas overseas, it's a really normal thing, and everyone's talking about, you know, a lot of people are sharing, you know, transparently what they're doing and reporting against that. And so with the code, one of the key principles of the code is that you do report your outcomes, and we're encouraging that to the extent is appropriate with the client, obviously, you constructively, and, you know, share what the conversation was about and the outcomes of that for that transparency mechanism, but also just to normalise this stuff. And again, it should be a normal thing that we're engaging to try and add value and navigate these issues. So I think Milford's a really good example of that with the reporting they've already done.
Thanks. And we because we want people to hold us to account to the outcomes that we're trying to deliver, and we also want them to see what we're talking to the companies about. Just, I suppose, demonstrating that kind of education on the specific issues that these companies should be improving that aren't always that visible. And so if, we think it's really important and someone else sees it and thinks it's really important, maybe they'll talk to them about it as well. So that's really good. So a couple, Stride Property Group's one, where it doesn't sound like a big emitter, but, buildings account for about 20% of global greenhouse gas emissions, and they are a big listed property company that were significantly behind their other listed peers in terms of what they do on collecting, measuring their own emissions, rating and disclosing the climate ratings of their buildings, investing in order to improve those ratings, because even though they don't disclose them, we know they're not going to be great, and generally trying to reduce the emissions from their portfolio and having targets around that. So they were a clear outlier, which is an issue for them and their share price, and they need to understand that, because they were pretty much just ignoring it, and then also just for general New Zealand emissions. So we talked to them, first of all, their sustainability team, who were typical sustainability people that are really passionate about it and trying to actually make a difference in a corporate that wasn't necessarily interested in really embracing any of their recommendations. And so they had a whole heap of ideas that were very similar to our ideas on how to improve. None of it was really complex. And then, so we had a couple of conversations with them. Then we had a conversation with the CEO and the CFO around those recommendations, what we thought would really, really progress, what were the really key things, which was putting in the actual ability to measure your building's emissions, actually just invest and get emissions measurements in there, set a target, and then have a CapEx plan to demonstrate that you will be able to deliver that target, as in refurb your buildings to try and get the emissions down. So new HVAC systems, LED lighting, the basic two that really kick those goals. And then we went and talked to the chair about it and had 2 meetings with the chair that kind of interesting, because they had a really split board. They've got one amazing director who is actually on the board for new climate financial disclosures, who's really, really passionate about it. But then they have a chair that is very, very much all about returns on invested capital. And if it doesn't deliver the required return on invested capital, then why would we do it? We'll just wait till we have to do it in 5, maybe 6 years, and do it then. And we're still doing a good job because we're going to do it at all. And so trying to change that mindset, actually demonstrate to him that investors don't just care about return on invested capital, they actually care about other stuff too. Because the excuse is always, oh, well, we're a shareholder, we're a listed business. Our shareholders just want us to deliver really good returns. And so that's our priority. So demonstrating that shareholders care about more things too was actually a really easy process, remarkably, because there was internal pressure, some external pressure, and they just actually went away and committed some capital, and now rolling out measurement for all their buildings, have set targets and massively changed their disclosures. So it was a great outcome, I think, for everybody.
Mm. We went a seminar earlier on in the series, which was a dialogue between an investment manager, Harbour, and KMD Brands, otherwise known as Kathmandu. And it was really interesting because what came out of the discussion was that it's hard for a fund manager to tell a company what to do unless it's part of their kind of overall plans and their core business logic. But what you can do is you can support the champions of sustainability and those who would create change within the company. And to some extent, the investor voice is often amplifying the sustainability team, amplifying the director who is keen to press in that direction. Is that a fair characterisation?
Very fair characterisation. It certainly makes it a lot easier. Our really difficult ones are now where we're starting, because we still own fossil fuel companies, and where we're starting with some of our small Australian fossil fuel holdings, so Karoon, Whitehaven, New Hope. And it's really interesting.
Don't have any of those.
Yeah, well, and this is one of the things that's come out of these conversations, is that we are the only person engaging with these companies, because most people exclude them because they cause so much harm. and they're not big enough to attract the attention of the likes of a Climate Action 100 plus. So they are happily mining away for coal without any shareholder talking to them about it. And that's difficult. But interestingly enough, their sustainability teams, and I think I mentioned this yesterday at the RIA conference, are still massively engaged in trying to get these companies to decarbonise. So you've still got that kind of core internal voice there. They haven't, which is funny. You would have thought their sustainability teams would be more of that deflecting type sustainability person, but they are not. There is, well, unless they are really good at deflecting. But there seems to be a genuine internal, there are some internal people that are genuinely trying to shift these companies in the right direction. So it gives us hope.
Let's talk about escalation strategies. You referred, Francis, to the fact that you have escalation strategies, but you haven't used them yet. Let's start with you, Jess. What do you do when the company is obviously not listening and not changing? What's your escalation pathway look like, and where are the trigger points?
Yeah, well, we haven't. The Woodside example I gave earlier is probably the example of how that works. I think escalation, and because voting comes around once a year, so these are sort of long burn exercises sometimes. And to be honest, we haven't really had to go through that escalation process. Sometimes we might just vote against a director or vote against a remuneration report or something for a completely different reason, got nothing to do with sort of escalation. We voted against the Aristocrat remuneration report last year just on the basis of their capital allocation strategy and their lack of transparency on KPIs and thresholds. So that's not necessarily escalation, it's just we think this is there was some fundamental issues. So the Woodside example is probably, how that would generally work is it starts with engagement. We look at engagement for a while, and then if that doesn't work, you start to think about potential voting strategies, or think about other mechanisms for, enacting change or creating, change.
The bit that I find really difficult is to set a line in the sand of what escalation measure to use when. When is the ongoing debate and persuasion not enough, and that becomes very individual to that particular engagement and the objectives that you're trying to get. So at what point do you draw a line and say, actually, we're sick of talking to you guys now, or we actually don't think you're going to make fundamental change, so we're going to raise a resolution at an AGM, or we're going to exclude you, or we're going to publicise an issue in the industry, or start to gather other investors. I don't know if, Jackson, you've got any thoughts on that?
Well, I think an important point to emphasise here is that, as you can hear, by no means is the first step of escalation divesting. And I think that's at times in New Zealand been a really common narrative that if you don't like something, you just get out, when there's many different ways you can engage and tackle these issues, and oftentimes staying in is a more effective way. So I just think it's important, and we're seeing this increasingly in New Zealand, that this escalation and having various different forms of engagements and voting is becoming an effective means to support companies, as opposed to making your statement by divesting.
But the threat of divestment is a powerful threat and gives you power in your negotiations. And I'm very well aware that the international context is Church of England, having engaged with Shell and other fossil fuel companies for a decade, said this is going nowhere. They're still spending all their capital expenditure, or much of their capital expenditure, on expanding their oil and gas development. So they said, okay, we're not going to engage anymore. We'll divest. And the Norwegian Sovereign Fund has come to the same conclusion on a number of those engagements.
I think for the very big players, that is a real threat.
Yeah.
It's not a threat if we do it.
That's right. Same for us.
If we say to BHP, we're not going to invest in you, they're like, that's fine.
Cool.
See ya.
We've got heaps of other shareholders. We might be one of their favourites, of course. We're a very good shareholder, but they've got lots of other very good shareholders, and they can easily get money in lots of places. So there is a difference between an asset owner, so if one of our very big super funds came out and said, we're not going to invest in X company, because that sort of stuff makes an impact, And I think that goes back to that point we were sort of making at the start around that leverage. I think as an investor, you've got to recognise sometimes limitations in your own ability to influence change, and really think about where that leverage makes the most sense. So that for us, that ongoing engagement does. And I'm not saying we would never divest a company based on escalation, but really fundamentally for us, it would have to break the investment case. So, and thermal coal, is an area that we don't invest in across all of our strategies because it, according to our fundamentals, it doesn't make sense for investing. But oil and gas and all of those areas fundamentally at the moment still do make sense under our sort of investment process. For us to divest one of those companies for our core funds, it eventually has to kind of break the case of why you should invest, or whether there's ability to make returns.
To come back to this a little bit, because I think a lot of people are really interested in this dialogue. If your clients are investing in you and you say, well, we're engaging with these companies, and they say, well, what progress is that engaging making?
Yeah.
If it isn't making progress, then don't your customers expect you then to say, well, we're not going to invest anymore?
It's a really interesting question, and I suppose the underlying premise of that is saying that unless you can deliver me a direct, attributable outcome from your ownership, you are not doing anything on climate or sustainability. Whereas if you just avoid that harm, even though you can't demonstrate to me any impact from that, then I'm happy. And that is fundamentally how people feel. They just don't like being associated with things that they don't like, whether that's going to deliver the most impact or not. I think we need to measure the two strategies by the same yardstick, and say that if you are ongoing demonstrating to the companies that you invest in that you genuinely integrate sustainability into your investment case, you genuinely care about these objectives and outcomes, and you're genuinely going to continue to push me towards them, then I probably should change as well. As at the same level that, if you say, we just won't own you while you still do this, makes the company say, oh God, I really should change. They both have merit, and we need both. And investment management, I believe, should do one or the other on where they are strongest. So if you are big and you are index, maybe exclusion is the best way that you can push companies. If you are big and you are active and you have a voice and management accessibility, maybe your best way to push companies is engagement. Maybe it's both. Maybe, we definitely need both. But I think, do you have to divest because your clients don't want to reduce emissions? I don't think that necessarily holds.
And I think everybody has a different perspective on
Yeah.
what is progress.
Yeah.
So, if you look at the oil and gas, somebody's progress might be that, Santos turns around and says, I'm no longer going to extract oil and gas. Somebody else's idea of progress might be that they have, put a pool of money aside to look at low carbon technologies, that they are improving their, climate change disclosures, like whatever it might be. And you get a range of views on that. You also get very different views between institutional clients and retail clients as well, because, in Australia, we have your future sort of requirements. So there is a really big focus on returns, and it's not about value-based decision-making, whereas for the institutional, but for the retail investors, it can be more like that.
Yeah. So we'd welcome questions from the audience. While you're thinking of your key question, let me just come back and we'll continue the conversation, but signal if you want to add a question. Reporting. So you guys are reporting on your voting positions and your engagement. You produce stewardship reports. What's difficult? I presume outcome reporting is the most difficult, where you're trying to say the result of our engagement is that we persuaded a company to do something different, and the outcome was these benefits for the climate or people or something else. That's really difficult reporting, right? Do you find ways to tell that story?
You go. You go.
Okay. It is and it isn't. I think the biggest thing is just being cautious about what you claim, because we're one of many voices. So, the Brambles example is a little bit different because, I am pretty sure that this hasn't been asked of them a lot, because when we sat down with the company, they were like, oh, okay, yeah. But generally, the broader conversations on climate or modern slavery, we're one of hundreds of investors probably that are all sort of talking about the same thing. So, I think that we do, communicate what we have done and then what we've seen the company do. But, and we are being pushed more to claim outcome, I think. Like we're getting pushed to be like, well, you're doing all of this work. What's the result? What's the impact? Can you measure that? Which you can, but implying that it's completely attributable just to our actions is a bit disingenuous and probably isn't the right way to go as well. But yeah, I mean, I don't think it's that hard. And I think if you're consistent in the engagement, those results come eventually. Like things take time.
Yeah, 100%, because the landscape's changing too. Regulatory risk is rising. We're seeing more the physical aspects of climate change, public opinion's shifting. It's very difficult to attribute outcomes to you directly. Even like Stride, when we are the only person engaging with them, they've done some absolute specific things that we told them to do. Is that because we told them, or is it because they're also increasingly aware that that's what they should be doing anyway? So it is, but I don't think that's a problem from a reporting perspective. I think it's a problem it's difficult from an engagement perspective overall. From reporting, just be really clear about what you've actually done, the outcomes, but then being really clear that you're not necessarily directly attributable, and the limitations of engagement. Voting, I think, is harder. I don't know if you guys have an opinion on this, but we look at trying to disclose more on our voting, and we disclose all our votes, and we disclose our proportion of votes with management, against management, on shareholder resolutions, with management, against management. But all resolutions are not the same, and saying that you voted with or against management on a management resolution or a shareholder resolution still doesn't necessarily say how you voted. Like, for example, did we vote against the Rio Tinto climate report because it wasn't ambitious enough, or did we vote against it because we don't want Rio Tinto to progress climate? And we do thousands of votes every year, and without saying how we voted for or against each one for each particular reason, how do you give really good disclosure on what you're doing? It's really difficult to do that with statistics. So that's something we find.
So do you
really
disclose your
difficult.
voting record and your comments? Because we have to.
We just disclose how we vote. ISS hosts the platform for us. So ISS is one of these. It's called Institutional Shareholder Services, and they're a proxy voting advisor. They give you advice on how to vote and an independent opinion on every vote, which is a whole nother can of worms, because they're becoming increasingly influential, because it's so easy to just say, oh, we'll vote in line with ISS and that means we're doing really well. But ISS, I can't remember the statistics that we were talking about when we caught up about this before, but it was something like they recommended voting in favour of, it was less than 10% of shareholder raised resolutions, and we'd voted for around 40% of them from memory last 12 months. And we would have liked to have voted for, we had some real debate on some of them. I would personally have liked to have voted for probably some more, but we decided it wasn't quite the right thing. So we disclose how our aggregate statistics on how we voted for and against, and then we list out every resolution. But we don't provide rationales or vote by vote yet, because without rationales, we don't want to provide vote by vote, and we can't write rationales for over 2,000 votes a year. It's just not enough of us. It's a 3-person full-time job.
And you've got a big portfolio to report against.
And Jackson, that's a common approach from what we've seen internationally. I'd make a kind of a tangent or related comment here around the resourcing for all of this, because stewardship generally, a concern is that it requires a lot of resourcing, and that's a barrier to some managers undertaking it, and reporting is naturally a part of that. But I would say using the engagement examples we've given, the collaborative examples, it's increasingly there's bodies that you can sign up to who can support you with enable you to do this collaborative engagement and provide you reporting data and things as part of that. So whilst it does take some additional resource, there's increasing mechanisms from a voting perspective and an engagement perspective to make it easier for managers to support these larger trends around the world. So it doesn't necessarily need to be prohibitive, particularly in New Zealand, where we're largely a lot of smaller managers with limited resource, particularly in the kind of sustainability team.
The context for this is really important, isn't it? because there is enormous amount of pressure on fund managers, particularly in New Zealand, I guess, in Australia as well, to drive towards lower and lower fees. And that's sometimes regarded as the kind of a measure of how good a fund it is, how low its fees are. And what we're talking about here is we're talking about having to put resources into what is quite a people-intensive process and data-intensive process in order to be able to exercise corporate governance responsibilities in a responsible way. So how does that work out when you're in your role saying, we need a team of 3 in order to do this? Does it become difficult in terms of justifying it against this driving pressure to lower fees?
Yeah, I mean, absolutely. That's the answer.
Yeah.
Yes, and yes, and yes. I mean, we could do so much more. We could be 10 people and still have more to do on stewardship. So it is cost intensive. Absolutely. I mean, maybe that's again why the New Zealand Stewardship Code can help provide some of that capability and capacity for people.
Absolutely, and enabling that collaboration to lighten the workload, particularly for the smaller managers. We say with the part of the purpose of stewardship is to maximise that long-term value by taking into account these environmental and social risks. So hopefully there's a connection there between stewardship activities and the performance of the fund. But naturally, it's still an economic decision around hiring staff at the time, well before those returns are seen. So yeah, it is challenging, particularly for these smaller managers.
It's also, I think it's the shared resources element, I think is important as well. Like, I don't think we should give the impression that like all the ESG is the responsibility of the ESG resource. So for example, like voting decisions for Alphinity, voting decisions are still made by the analyst with my support. And I make sure that they get executed and all of those things, and everything kind of goes through from a process perspective, provide insight based on what we might have done on other votes or other similar things. But that sort of sits with them. We do the same with sort of issue management on different ESG areas, and we do the same for engagement as well. So not every ESG engagement is necessarily run by myself or my colleagues. We've got a 2-person team in Alphinity. It can be run by the analyst. We'll feed them the questions. They'll come back and let us know. So I think that's important as well, that it is like very much a shared responsibility, because it is considered core to, the investment case and the fundamentals and what we do.
So we're coming to the end. So raise your hand if you want to ask a question. But I'm going to give the floor to you for a little while, Jackson, to talk about the New Zealand Stewardship Code, a bit more about where it's come from, where you're up to, the sort of guidelines on reporting that you're developing, etc.
Yeah, sure. So just briefly, the Stewardship Code was born, I guess, out of the Sustainable Finance Forum's Roadmap to Action, which was released a couple of years ago and sets out how New Zealand can best transition to a more sustainable finance ecosystem. One of the recommendations within that was to develop a stewardship code on the back of the kind of growing momentum in the space globally, particularly in the UK. They're seen as kind of the gold standard, the leaders here. They have 250 signatories, I think, to their code over there, and that number's really growing. So off the back of that recommendation, an industry-led body came together across 18 months to collaborate and co-design this code, and that resulted in the code being launched about a year ago now. The code has 9 principles that, effectively set out the framework that my colleagues have been talking through to engage with businesses and support them to navigate these issues. We have 18 signatories now, and that's between them, they have over half the assets under management in New Zealand. So it's a really large and growing part of the New Zealand market. And the focus for us is to really broaden the extent of stewardship activities by getting more signatories signed up, as well as deepening the effectiveness of the stewardship activities that those existing signatories are doing. So that's why we have those regular calls. We're working on guidance to support that reporting piece and other key aspects to really lift the quality of stewardship activities and, most importantly, the outcomes that New Zealand is experiencing.
Cool. Yes.
Question both Francis and Jessica. You mentioned being a small voice, especially in comparison to the pension funds voting, or in terms of threatening divestment, especially from Shell. Would you be interested in working together or joining other small voices to form a voting bloc that also kind of speaks to, you said you're low on resources in this space. If there's a group that made those decisions and said, just do this, we're going to threaten now all of us. Would you be interested in that, or is it just way too far outside?
I think it would still be like assessed on a case by case. It's similar to proxy advisors, and we've got some organisations in Australia that do some of that stuff around specific topics like climate, where you sort of subscribe to the research and take the advice. So the decision making still needs to kind of set internally. But I think that is it's a good mechanism. And there's a bunch of them in the global space that sort of advocate for seed something, know your seed, or seed sow your seed, something like that.
As you say, yeah. and Sarah's and
So there's a few things like that, and I think there probably are managers that, particularly the really like ethical bent, that would be like, all right, fundamentally we subscribe to these values that this organisation is, putting out, and we're going to sort of take their advice and vote. For us, we would generally, do case by case.
Yeah, that's the problem, is trying to get that consensus on each vote. That's absolutely the problem with that. And so even when you're aligned on issues, the votes become so specific that it's like quite sometimes, I guess you need to take a step back and say, hey, this issue is moving in the right direction, so we want to vote this way. But there is a lot of room for different views. Yeah, so I think in principle, absolutely. And so particularly for smaller shareholders, it's a really good idea. But in practice, it does become quite hard to organise and navigate, I think.
Thank you.
I think we're going to call it quits there. Thank you to our panel for a really interesting discussion. Really enjoyed that. And thank you so much for bringing your expertise and knowledge on this. So please give them a round of applause. So just to say, this series of seminars wouldn't be possible without generous sponsors, and particular reference to Alphinity, who's been one of our generous sponsors, but also Medical Assurance Society, Mercer. Thanks to Mercer, and New Zealand Green Investment Finance. Also thanks for sponsorship to Chapman Tripp, Booster, Harbour Asset Management and Trustees Executors. And we've also had sponsorship contributions from Pathfinder and PyFunds. So next week, we're going to do a deep dive into renewable energy. Not only because the announcement yesterday that BlackRock will form a new renewable energy fund themed on renewable energy in New Zealand, but it's a nice coincidence because we were going to do that seminar anyway. It will feature research from Rocky Mountain Institute, RMI, and one of their lead authors, Kingsmill North, is going to talk about what RMI's research is saying about the acceleration of global investment on renewable energy. We're going to provide some New Zealand context on that and on the transition from fossil fuels to renewable energy. So that's happening at 12:15 next Wednesday. I think it'll be a really good one. So please join us. Thank you for coming. Thank you for watching online. Thanks for watching the video and listening to the podcast. Stay active. Invest mindfully. Ngā mihi nui kia koutou mā te wā.